welcome back to the program. It's the very first edition of Capital Market Live on Channels Television this year, happening 5th of January, live right here on the television, Channels TV, your award-winning station, don't forget that. Well, our guest has been Gbolahan Aina of Codras Capital, the head of investments, and together we've been looking at some of the external and internal factors that will shape your investment decision in the new year, 2019. So Gbolahan, let's look at the fact that in the public space, we have budgets funding to do. We have federal government's borrowing strategies. Last year, they externalized a lot of the debts. Some people have also projected that in 2019, they will be challenged, borrowing externally. Do you agree with that too?
Yeah, absolutely. So what we've seen is because of the rising interest rate as well, so they are going to borrow at a higher rate. So if you look at the debt that they borrowed in February compared to the one that they concluded latter part of the year, was much more higher. So for the 12-year tenor, was about 7% in February. When they borrowed in November, it was 8% and above. So it's going to be more expensive for them to borrow externally. And of course, when you're borrowing externally, there's also the foreign currency risk as well. So they have to put all that in mind.
So in essence, money is going to move away from a whole lot of other portfolios back to the debt markets this time.
Absolutely. So what debt market does for you, one, there's safety, there's capital preservation, and because you're sure that you're not going to lose whatever you've invested in. But if you are trading those bonds wherever, you can actually lose because those bonds have prices. But if you are waiting to maturity, because you are sure that you get whatever.
Are there chances of any losses for any investors? Because again, I mean, with the federal government doesn't really seem to have good headroom in terms of the revenues that they will be generating from crude oil sales this year. So they might still want to sustain their borrowing strategies in the domestic space.
Yeah, definitely. So it's going to be a mix of domestic and also foreign borrowing. So I expect for them to borrow, but it's going to be more expensive either ways. So, for instance, if you look at the local bonds, at some point in 2018, they were as low as 13%, but we close the year with them, the yields at over 15%, and the yields are still trending up. So we expect them to borrow maybe in the region of maybe 17% whenever the debt program comes. But it's good for investors because you're going to have higher rates on your investments.
But it's bad for the federal government because the cost of servicing this borrowing is also going to be on the high side eventually. Do you anticipate a hit at about 20%, the levels where we saw it some 3-4 years ago?
I don't think it will get to 20%, but it might get close to 20%. The one-year T-bill is already getting close to that. Is about 17.9%, which is close to 18%. So in terms of how people invest, I've been telling them to maintain a short duration. So, of course, they don't go too long because you still anticipate that yields are going to go up. So if you go long now, you're already locked in, you might not benefit from rising interest rates. So really, the investment advice is maintain short duration. So when interest rates rise, you can also partake of the rise in interest rates.
So, but basically, we've seen a whole lot of aggressive mop-up on the part of CBN. But then given the interest rate hike that is likely to happen in the international markets and the fact that revenues from crude oil will be highly challenged this time, are we likely to see interest rates raised here too by the CBN, MPC?
Yeah, so a lot of factors affect interest rates. So one is inflation. Inflation are a bit pressured. And if you look at the month-on-month food inflation, it's been pressured. One, you know about the farmers and husband clash. It's persisted for over a long time. Also, for a lot of the farmers, they've left their residents. So really, that farming activity in all those communities have not been sustained. So we expect food inflation to be challenged. We expect increase in fuel price. So if that comes, it's going to affect it's going to be like a cost push inflation as well. So there's inflationary pressure. Also currency as well. So really, CBN usually wants to give us an incentive for FPIs to borrow. So they want to maintain a risk or an inflation-adjusted return. So really, they want to ensure that interest rate is above what inflation is. So all that points to the fact that there might be a likely rise, maybe not massive, in the interest rate. There's an MPC meeting in January.
Absolutely.
But we expect status quo in this meeting.
Okay, so we also know minimum wage is going to be increased. What sort of impact or implication is that going to have on the macroeconomic space?
Well, so it's going to affect inflation as well. So really, consumer wallet is going to increase. There'll be more money chasing few goods. There's going to be they're going to cause a rise in inflation in that regard. But my worry is that a lot of state governments might not be able to pay that. On the federal level, it might not be an issue, and that's why all the governors have been are finding issues to agree to the minimum rate that's been proposed.
So there will be more money for a lot of individuals, but there won't be much to invest actually for the rainy days. Okay, let's look at what will happen to equities and fixed income generally now in the first quarter. In the first half of the year, we understand that things are likely to wane, basically. We're going to see losing streak. But how optimistic are you about the second half post-election? And of course, there are predictions that in the in Q3 or basically, or half year, second half of the year, we're likely to see PMS, price jump.
Yes, so for equities, for this year, I'm not too optimistic. And in terms of approach, I always tell people, please try and stay in safe havens and stocks that are resilient. Like I was saying earlier on, for Q1 election year, 2011 and 2015, market suffered a decline. But post-election Q2, market rallied, gained about 4%. After the announcement and all that. So for this year, I expect activities to be muted. A lot of things are going to be shaped by what happens in the global space, not just in the local space. And if you look at last year, again, that was what shaped investor sentiment.
Right.
So there was a lot of outflows from FPIs. So if interest rate is going to be hiked in EU and in US as we expect, we don't expect so much inflows to come into this market. So that's going to be a major challenge post-election.
So if you're a domestic investor, retail, institutional, domestic, pension fund administrator, what should you do with your money in the first half of this year?
Well, so really depends on your objectives. So if you're investing short-term, really money market instruments is the way to go. Short-term also helps you meet your obligations. So you're matching asset with liabilities. So things like your treasury bills, your commercial papers, or your money market mutual fund. If you're investing long-term, there are so many alternatives. So recently, we've seen a lot of evolution of alternatives. We are seeing people invest in agriculture. We are seeing people invest in real estate. For agriculture, you need to do your due diligence, and you need to be sure who you are investing with, because really, not all of them are regulated. For real estate, there are a lot of depressed property prices at the moment. So you can buy those property prices at those depressed prices. And also because there's a housing shortfall in Nigeria. But we've seen that there's a mismatch. Most time people build houses at the high end of the market. Really, the demand is at the low and the medium end of the market. At the low end of the market, really, there's usually a high default rate because some of them cannot pay the rental. But the medium end of the market, a lot of them are upwardly mobile and can be able to afford those rents. So you can go real estate, either buying those land or rental yield.
But any major expectations from regulators, the CBN, the SEC, the NSE, by way of helping to mitigate some of these unexpected risks that we will see this year?
Well, so
I know you're an operator, so you want to be careful.
Well, there are a lot of things in the works, but a few things to look forward to in the equity space. I think we might eventually have the MTN listing this year. Okay. They seem to have concluded with CBN the issue that they were having last year. Also, Dangote said Dangote is going to be listing at the London Stock Exchange. So that is exciting. So that's something to look forward to. There are a lot of rights issues that are coming up. So there's going to be a lot of activities in the equity space. I'm excited, but why I say that investors should trade cautiously. They should do their due diligence, and if you invest in the equity market, invest long term. Also, if you look at the equity market, there are a lot of banks that are giving you 7% dividend yield, which is attractive. So you can key into those banks when you pay dividend, and you can probably exit after you receive your dividend. So
in a nutshell, what you expect from the regulatory side is approval, swift approval for some of these things.
Definitely.
Well, Ahoyano, thank you so much for speaking to us. It's a happy new year. You said you're optimistic. Investors get more optimistic. Well, Ahoyano is the head of investments at Quadras Capital. Thank you so much for being a part of our program this evening. That's all the time we have for the first edition of the program. I'm Temple Ashaju. I'll see you next time. Bye for now.